Welcome to the Royal Economic Society session on the risk and uncertainty in macroeconomics. My name is Federico Ravenna from the Central Bank of Denmark and the University of Copenhagen. I'll be chairing the session. We have four. Okay. Sorry, something is not working on my end. Okay, why don't we start with the first paper? Sarolta Lasso is going to present a paper on efficient risk sharing and separation. Sarolta, go ahead.
Thank you very much, Federico, and thanks for everyone listening. So this is joint work with Arpad Abraham, who is at the University of Bristol. And this paper is about essentially the interaction between partial risk sharing and separation. And in this paper, we're gonna discover hopefully interesting and surprising mechanism related to these. So this is a theoretical paper mainly. And let me first say a few words about the basic setting, because maybe not all of you are familiar with these kind of models. Okay, so it's going to be a very sort of simple setting where we consider just two agents who each have some income or endowment. Okay, the total endowment will be constant, just this capital Y, and each agent has some income or some share of this total endowment. Okay, so suppose the first agent is the lucky one, so has higher income. Okay, the only way to ensure in this very simple framework is to make transfers to each other. Okay? And in this way, so without any frictions, perfect risk sharing could be achieved. How? Simply the lucky agent needs to make a transfer such that then both agents consume half of the total endowment. Okay, so far so very simple. Now, where does the partial risk sharing come from? In our framework, it comes from limited commitment. So this goes back to Thomas and Warren Kocher-Lakota. So essentially, the idea is that this agent that is lucky today might be unwilling to make a large transfer today due to impatience. Okay, so then this model requires each agent to be at least as well off as in old Turkey at each time and after any history of income shocks. Okay, so essentially we introduce these participation constraints. And when this participation would be violated at this allocation where the total endowment is shared equally, then we make that agent just indifferent, and this will yield partial risk sharing. Okay, they may make some transfer, but still will consume more. The lucky agent will consume more than half the endowment. Okay, this is the basic setting, and you may have seen this kind of idea in many applications. So this is a non-exhaustive list of applications, and this basic model comes from Thomas and Warren and Kocher-Lakota. There's also a textbook treatment of the one-sided versions more in Linguist and Sargent. It had many applications. Okay, you can think of household sharing risk in villages or in the United States, and I'll get back to Kruger and Perry's paper on how consumption equality depends on income inequality at the end of my talk. Hopefully I get there. Also, you can think of risk sharing between members of a household, and this is an application we kind of have primary in mind here, in fact. Okay, or between countries, such as in Keogh and Perry paper on international business cycles, employee and employee. Although I'm not gonna, this is a bit far, so we would really have to stretch our little model to incorporate this employee-employee interaction, but it's one thing where we, in a direction that one could move, but I'm not gonna sort of talk more about it, and it's a literature I know less of than some of you, so I'll avoid talking much about it. Or you can think of even political parties, interacting. All right. So now that I sort of set out, our starting point, let me tell you what we really do in this paper. Okay. So in this basic model of limited commitment, there's partial risk sharing, which is a useful element that captures a reality, but there are no separations in equilibrium. Okay, We are not the first one to think about separation, but we do it in a different way and we get new results, as I hope I will convince you of that. Okay, so how we do this, we introduce what we call match quality shock. So there is some utility value of being in this risk sharing arrangement on top of this possibility of smoothing consumption. Okay, and then, you know, to sort of jump ahead a bit, but what happens is then an agent receiving a sufficiently negative MQ shock will imply separation. So it will become impossible to satisfy their participation constraints. Okay? And then these shocks, on top of it, will also affect risk sharing within the partnership, even when separations do not occur, because they influence the participation. They enter into the participation constraints. Okay, so we'll formalize and characterize this economy and highlight some new features, and in particular, this interplay between partial risk sharing and separations. Okay, so let me now get more formal. So our starting point is Koshel-Lakota, that many of you might know well. So we consider two infinitely lived risk-averse agents who are ex-ante identical. Utility is bounded below. Income takes a discrete number of values. And again, agents may leave this arrangement or may default whenever it is optimal for them. And so we had these mesh quality shocks, which will denote alpha, that will follow some symmetric around zero distribution. Okay, so in terms of mathematics, it looks like this, and I highlight really in blue what we add, okay, to the standard model. So what you see here is a weighted sum of lifetime utilities of several agents, okay, in simplest case 2. So we have an initial Pareto weight lambda I. So agents get utility from consumption. So this S upper T is just the history of shocks. Okay, so they get utility from consumption, and they get this utility, the additional utility shock from being in this partnership that we denote alpha. So okay, there's a history, the probability of the histories of states, and we discount the future. Okay? So there's no intertemporal technology here. This is something that we want to introduce in our next sort of as a next step or in the next paper. But so here it's not really important for the key mechanism here. So here just sum of consumptions have to be the total endowment. Okay, and then we have this participation constraint. So on the left-hand side here, we have the expected lifetime utility from some time and state onwards. Okay, so it has sort of the same structure as this objective function. So here we have this. So essentially lifetime utility from today onwards staying in this partnership. And on the right-hand side, the lifetime utility from autarky. So this is a participation constraint. This I can specify in many ways. Think of it just for simplicity as, you know, you just consume your own income every period. Okay, so I'm going to simplify a bit. Partner one gets income wide, the other partner gets the rest of the total endowment. And to fix ideas, I'm going to assume that partner one gets this shock alpha and then partner two minus alpha. Okay, this can be general. This is a very sort of nice setting for the following reason. Now, if I'm assuming equal Pareto weights, then what happens under full commitment or at the first best is that consumptions are equal and there is never separation. So this is a nice benchmark here. Okay? So everything will come from the limited commitment that generates partial risk sharing and then separation. So essentially under this assumption, at the first best, these MQ shocks drop out. So essentially there's no aggregate risk in this value of the match. Okay. So I'm going to be very brief on our theoretical results in the interest of time, but I need to tell you one, the first main, kind of important result, which is on this slide. So as I already said, so it's large enough negative MQ shocks that will make it impossible to satisfy participation constraint. So there are sort of two types of sets given income, okay, on these MQ shocks. There will be what we call a separation set and then non-separation set. Okay, so given income tomorrow, there will be a set of alphas where this partnership cannot continue, so the agent will separate, and in other set they stay together. Okay, so and we can characterize these sets by some thresholds. These are not necessarily unique, as I'll get back to later. But so this solution can be first step of the characterization is if you think about a uniform distribution, sort of the two extremes, there might be separations. Either one agent gets a large negative shock or the other, and these are the cases when you separate, and this of in the middle you won't separate. I mean, simplest case, if the shock is 0, then we are back to the basic model. Okay. So now using this characterization, I can write up the problem in this recursive form. So characterizing a Pareto frontier with a promised utility U to the other agents. Okay. So just very briefly, so utility comes from what we get today from consumption and this match quality. And then tomorrow, two things can happen. Either we stay together or we separate. Okay, stay together, then there are tomorrow's values. So for such MQ shocks that we can stay together, okay, and with some probabilities, again, when we are at the extremes of these MQ shock distributions, so we separate, and then each agent gets the autarky utility. So this is the utility of partner one, and then there's a promise keeping constraint that looks, it has the same form. So I promise deliver this utility capital U to partner 2, and then I can write the participation constraints in the following form: that to agent 2, the tomorrow's promise must be at least as high as the value of autarky, and same for agent 1, their value must be higher than autarky. Okay, all right. So that's the model.
Sarolta,
okay.
You still have 5 minutes.
5 minutes, okay. So I'm going to skip most of the analytical characterization. But I'm going to tell you this interesting result with respect to consumption inequality, which I think is sort of a novelty here with respect to the basic model. So here, for some sort of relatively extreme values of the shocks, but not such that we separate, what happens is consumption inequality exceeds income inequality, which is not something that can happen at any time in the basic model. Okay, so this can happen at any history of shock. So if you observe such a, in the data, this happening, it doesn't have to be sort of measurement error. It can be an optimal thing so for this to happen. And so this leads us to an empirical implication. Again, this is a theoretical paper, so we're not going to in practice test this. But consumption inequality also provides then, well, not fully revealing, but information about unobservable MQ shocks conditional on income. Okay, so for example, if I observe that consumption is very high, I know that these shocks have a large absolute value. Okay, and if these shocks are persistent, which you would expect probably in applications, then this also provides us with information about future separation probabilities. And again, this is something that could be tested. All right, I'm going to skip this. So I'm going to show you in the last few minutes that I have. Clearly, this time is very short. Just put some numbers to it. Okay, this is not really a calibration, just some reasonable numbers. So this is what really puzzled us, and then it took us a lot of time to try to understand what's going on here. So what happens? So look at first just the blue line, the solid blue line. These are the constant efficient equilibrium. So what I'm doing here, I'm changing the variance of this MQ shock, okay, and just solving the model, finding the probability of separation. So what you can see is like a big jump, okay. I'm moving this essentially, if it's uniform, you can just think of extending the support, and I get this big jump. Okay. Let me not talk yet about this topic. Just focus on the solid line. Okay. So where does this come from? From here. And again, this is a picture with lots of things. Let us focus on the red solid line, which tells us the separation threshold. So essentially, for the agent who has a high income today, is the lucky one, gets sort of minus this alpha star match quality shock. So again, what you see, the key thing here is that you see this jump. Okay, so for low, these are the sessions. This is above the 45 degrees. There is no separation. When I get separation, suddenly I get a lot of separation, right? Where does this come from? Okay, so this is just sort of a description what happens. So below some value, okay, this is below this threshold, we have no separations, and then we suddenly have a lot. So what is going on? Okay, so this is the key question. And another that's important to understand this is that at this threshold, the other partners' participation will be slack. Okay, because I was not, this threshold really wasn't at the bound. Okay, it was way above. All right, so what's going on here? So what I would want to do, so if the other person's participation constraint slack, then why can't I just, take some utility away from this other partner and give it to the one with this high negative MQ shock, right? So I could increase their consumption, right? And so why can't I do that? This is, now here is, look at the blue line. So essentially I'm keeping, as I'm increasing this shock, I'm moving the direction, but you see that this thing is getting vertical. It's quite intuitive in the end once you understand what's going on. So what happens is that lifetime utility from consumption has an upper bound in this range, to total endowment and half the amount. Why? Because it's a dynamic model, obviously. So if I'm consuming C today, there's a future period when I'm gonna consume the total endowment minus C. Okay, as I keep increasing my consumption today, with some probability, in a state tomorrow, I'm getting very, very low consumption. Okay, so essentially, I can't increase the utility from consumption from sort of indefinitely in this framework. Okay, so this is the first key thing, and then. So what happens then? So some separation starts happening, okay? Suppose, with a very, I have to move these thresholds of inside the support. So some separation starts happening. That means the continuity goes down. So again, today, the pieces become more stringent. This decreases risk sharing. This will trigger more separation, okay? So this is sort of a key mechanism here. So this is an amplification cycle, and what is really happening is there's a complementarity between current and future risk sharing and staying together, okay? And there's complementarity, so, but this is kind of not enough for the jump, okay? I could still just have, just very steeply changing threshold. So there's this explains the amplification. So there is a final, this is a very technical element to the story, which is that given that one piece is binding and the other is not, the value function of this partner one is actually flat on a range around that threshold. So I need to, as I'm moving alpha, I'm always compensating, just keeping this agent at their autarky value. Okay, so I need to move this threshold to get to a range where this piece is no longer flat. Okay, so then I take 1 minute to tell you what other results we have. So there's a new type of equilibrium emerging in this framework. Again, this is very much related to this complementarity that I emphasized. Okay, but see, a new type of equilibrium, it's not a new equilibrium because I'm changing the outside option. It's a new equilibrium coming from sort of, you can think of what I believe about the future, how much cooperation, how much risk sharing there will be in the future that will influence how much there is today. So even keeping the punishment constant, this new type of but inefficient equilibrium emerges here, okay? And then, so I don't have time to go through this. So we are thinking about also how income inequality affects consumption inequality, as in Kruger and Perry. The key new element here is that income inequality will also influence the probability of separation. So there is this new channel via which income inequality influences consumption equality. And under some parameter values, the results sort of it gets overturned. So how include and pay more income inequality leads to more risk sharing and then less consumption equality. Here it once these there's separations kicking in, the opposite can happen. So let me conclude. So the key thing we highlighted here is this complementary between risk sharing and staying together. So there's this new inefficient equilibrium. So there's this jump. And this really implies that I haven't yet emphasized that a small change in the environment can change to a large change in outcomes. Okay, so this can also think of, because this income risk can be sort of also, as you know, how much can be related to the tax system. Okay, it's more related to the tax system. There is less income risk that agents bear. So this small change can, trigger all these large changes via the separations that can happen in equilibrium in this model. Okay, and so all this we did. We really wanted to do this with savings, but then we sort of this weird thing were happening. We didn't understand what was going on. So we decided to dig into this basic model without the saving. So that's what we're gonna do next. So think about the interplay between this, so risk sharing separations and saving. So saving is also for the rainy day of divorce, as possibly. And so think about also more quantitatively about household saving in this setting. So I guess I took all the time for questions as well. I don't know.
Thanks, Sarolta. If we'll see if there are questions. Everybody can write a question through the RES platform on the website. I haven't seen any question coming in. Remember, also for future presentations, you can write questions at any time, and I'll report them at the end for the speaker. Does any of the panelists have one final brief question for Sarolta? Sarolta, thanks a lot. If we have a bit of time at the end, I'm sure the people will have also some comments and questions for you. In the meantime, then let's move on to the second presentation. We have Stephen Terry presenting his work on using disasters to estimate the impact of uncertainty. Stephen, if you can share your slides. Okay, thank you. Go ahead.
Perfect. So thanks so much. Let me get these slides back up. All right. So thanks everyone for being here, and to the organizers for putting the session together. It's been a pleasure to be a part of this so far. So I'm looking forward to talking about disasters and the impact of uncertainty. This is joint work with Scott Baker and Nick Bloom. So we're motivated by a simple correlation, and this correlation shows up all over the place. The correlation that we see is that uncertainty, by which we mean some notion of risk or second moments, tends to go up during bad times, by which we mean times with lower levels or lower first moments or average outcomes. And this shows up at the macro level, more stock return volatility, some sort of kind of more sophisticated notions of aggregate uncertainty. They tend to go up during times of decline in economic activity. Shows up at the micro level as well. Things like micro stock return variances, plant TFP, forecast errors, a range of proxies for risk at both the micro and macro levels tend to go up during times with low economic activity, bad times. Okay, so we're starting with this correlation, quite systematic in the uncertainty literature. So let's ask a simple question. Is it causal? Okay, there's a problem with asking questions like that. There's a challenge, right? And Kosher Lakota shows up in the second of the two presentations here, which is that basically everything in macro is endogenous. Okay, so what do we do? Well, there are a few routes to try to go at attacking some question of causality. A lot of theoretical literature on uncertainty doesn't try to empirically suss this out. Often macro models with uncertainty, not all, but most of them bake in some sort of assumption that links increased uncertainty in the presence of some curvature for firms or households to bad outcomes. And we get some sort of causal mechanism that's typically assumed that links higher volatility to downturns. Okay. There's also a macroempirical literature that tackles this at the aggregate level. And often people are using VARs of various sorts with a range of different identification mechanisms, whether it's standard recursive stuff, fancy news shocks, penalty functions, event-based stuff, really fancy nonlinear Bayesian models. This kind of time series empirical literature tends to find more mixed results. Sometimes uncertainty causes bad times. Sometimes it's the other way around. Sometimes it's a mix of the two. There's kind of a range of answers all over the place. We're going to be adding to this macroempirical literature using a different approach, so a new approach, still aggregated, but based on a cross-country data set. We'll be looking at economic activity and proxies for uncertainty, but also using disaster events in a specific way. Okay, so what's the data we're working with? I already told you it's some cross-country set of information. We've got about 60 countries in our sample. Kind of a range of low, middle, and high income economies, some big economies, a lot of small open economies at the quarterly frequency from about 1970 until very recently. And we're measuring things like GDP growth for these countries, as well as stock returns, both at the aggregate and disaggregated firm level within this panel of nations that we have. And we're going to complement this information with data on a broad set of different types of disasters that occur in this panel of nations. So you got information on basically high impact, high economic and casualty cost natural disasters like earthquakes or big floods, terror attacks of various sorts, kind of events that lead to large casualties and are quite salient, and two different types of government takeovers. We split right-wing government takeovers, call those coups, into kind of one group of government takeovers. And we also look at revolutions, so kind of takeovers of governments by left-wing groups. All right, so we've got this information on economic activity, some stock return data, and disasters of various types in this panel of countries. What are we going to do? Well, let's start with something simple, which is a simple univariate panel regression structure that's linking for country C and quarter T here, a measure of changes in activity, so GDP growth on the left-hand side, to a rich set of country and time dummies, but also proxies for first and second moments in these nations. Okay, so what do we mean by first moments here? Basically, we mean the aggregate stock return, either the return on the aggregate index or averages of our micro stock returns. Okay, some notion of changes in the level of asset prices in an economy at a given quarter. And then by second moments, or uncertainty here, we're going to be proxying uncertainty and in a range of ways. Doesn't really make a huge difference for the results I'll show you. We could look at things like the time series volatility of the macro stock return index. We could look at the variance of stock returns at the micro level within a given economy and period of time. We can look at indexes of the two notions of volatility. So we're going to kind of explore the different measures of uncertainty in a broad range of ways. Then we're going to do what? Oh, not just going to estimate this thing via OLS and pick up that correlation, which, as you can probably predict, is quite negative between second moments and growth. We're going to be trying to attack some sort of causal question. We're going to be instrumenting jointly for both first and second moments of stock returns on the right-hand side with the disaster events in our data. So these natural disasters, terror attacks, coups, and revolutions. Okay, so what's going on here? I can just tell you I'm instrumenting and tell you that you should believe me and jump to the regression, but let's actually talk about what's happening with this identification strategy. So let's imagine that I just have two types of disasters. I've got four, but let's think about two. One, type A. Let's imagine a world where that causes declines in levels or first moments, but doesn't impact uncertainty. It doesn't really increase the unpredictability or risk of anything in future. But disaster type B, by contrast, causes a reduction in activity, but also increases risk or uncertainty. Okay, so intuitively, in the back of your mind, you might think that if this is systematic enough, we might be able to use these heterogeneous mappings of the different types of disasters onto levels versus volatility to kind of suss out the impact of uncertainty alone rather than just declines in activity. And that's basically what our IV analysis does. It formalizes that the mappings from disasters to the first and second moments is the first stage of this regression or this IV analysis. The second stage then does this kind of comparison, kind of isolating the marginal impact of uncertainty, not just levels. So what do you need to believe for this type of thing to make sense? Okay, like what are the identifying assumptions? Right, if you don't believe these things, you shouldn't believe our results. All right, but what do we want you to believe? So for the first stage to make any kind of sense at all, it has to be the case that the disaster events map in some sort of stable fashion to heterogeneous shifts in activity, like levels, first moments, versus volatility or uncertainty or second moments. That's something in principle we could get more of a handle on in the data. The exclusion restriction, as always, is a bit trickier. This says, basically, that these disasters and their impact on activity or the economy is fully encapsulated by shifts in first and second moments and asset prices that we see in the economy in the same time period. So this doesn't mean that disasters only affect the economy through asset prices and the money in the pockets of whoever has these asset prices, but that whatever impact these disasters have on the economy shows up in those movements or is reflected in the movements in first and second moments we see. Okay, so without further ado, let me go ahead and dive into our results. Okay, so let's show you a panel of regression results where all of these are versions of that simple panel specification I told you before, which means the outcome is always GDP growth. And the first column here is just an OLS regression of that on first and second moments, so levels and volatility of stock returns. And as you can see here, the levels of stock returns are positively correlated with activity. Whew, that kind of makes sense. It accords with our basic notions of how these things probably work. And uncertainty is negatively correlated with GDP growth. Right? That's basically a formal restatement of our motivating association or correlation in column 1. But then let's look at column 2, which is a kind of baseline IV specification. And in this structure, what we're going to do is employ our IV strategy. We're going to instrument for both first and second moments of stock returns using this set of 4 different disaster events. Okay? So what do we see in this first stage portion? Okay, well, in the first stage 4 first moments, or the first stage 4 levels, and there's way too many firsts and seconds floating around, in the first stage 4 levels here, we're going to see that we have strong predictability and things like terror attacks tend to map to negative levels of stock return shifts in a given economy. And then government takeovers also have big impacts on level shift in asset prices. Turns out right-wing government takeovers tend to boost asset prices meaningfully. Left-wing takeovers tend to lead decline in asset prices, which kind of motivates the heterogeneity. Natural disasters actually don't have a huge amount of impact in this context. In the volatility first stage, the final block here in the table, we're going to see that we also have predictive power for these shifts in volatility that we're interested in. So while they have heterogeneous impacts on first moments, all of the political takeover events lead to meaningful increases in volatility, and terror attacks do as well, with again, actually fairly little movement from natural disasters here. So in the second stage, what we're going to see is a meaningful second stage impact of uncertainty on GDP growth. The units here are a 1 standard deviation increase in uncertainty, leading to about a 6.5% year-on-year decline in GDP growth. So these are large numbers. There are also a lot of kind of small, low income and small open economy nations in our sample. So these are large numbers in the broad sample. They're a little bit lower for rich nations, but still precise. And these types of results, if you look at the other columns, are not incredibly dependent upon whether we define uncertainty using an index of micro and macro fluctuations as in our baseline, or do things like just look at micro or macro notions of volatility. Okay, so we can move on from the simple univariate panel regressions that I started with to also do something a bit richer econometrically to allow for more dynamics and work with a VAR version of those univariate regressions. So thinking about a simple VAR that has a panel structure across countries with activity or GDP growth, first and second moments of stock returns being the variables of interest, and compute the impact of uncertainty on GDP growth, or compute the impulse response of GDP growth to an uncertainty shock, using as an identification tool exactly the same disaster events that we have in our univariate approach. In other words, we can use this IV VAR approach to identification that Mertens and Raven or Stock and Watson have popularized recently to do a similar type of impulse response analysis. And in that type of dynamic structure, what we're finding is something reasonably similar, a responsive activity to a 1 standard deviation increase in uncertainty that's quite large and persistent here with drops of around 4%. Okay, so whether there's a simple univariate panel specification or some more dynamics, we're finding a negative impact, and we're arguing to the extent that you buy our identification strategy that this appears to be a causal link. And let's now take a step back, okay, and say, I've shown you some aggregated evidence.
Steven, you still have 4 minutes if you would like to have some questions.
Okay. Perfect, great. So, we want to take a step back with the empirics in hand and ask a question that I think is often important to ask when somebody puts a new empirical technique like these disaster methodologies on the table and say, does it actually make any sense in a model of this underlying phenomenon? And so what we use is we adapt a model that we've used before, and this is a micro to macro model with heterogeneous firms that links uncertainty fluctuations in business cycles. And we check the disaster IV approach within that structure. So the model has firm heterogeneity, lumpy capital adjustment, and time varying volatility or uncertainty in TFP at both the micro and macro levels. And in this model, which we view as kind of a benchmark or workhorse model of uncertainty in business cycle fluctuations, increased volatility leads firms to freeze up. There's like a real options or wait and see effect, and you get a recession that is, within this structure, a causal result of increased uncertainty. And so what we do within this model is we adapt the driving processes to allow for and incorporate some IID disaster shocks that can have various types and map flexibly onto either average or levels changes in TFP or volatility changes. Okay? And then we structurally estimate the underlying mappings from disaster events to the TFP driving processes, levels and volatility, by matching the univariate IV regression information that I showed you empirically that links disaster events to stock returns within the model that allows us to talk about both macro and micro simulated data. With this in hand, we then ask, does the simulated model data actually yield empirical estimates, anything like what we actually saw in the data? And the answer is yes. If you repeat this VAR exercise from the data in blue, which is what I showed you a second ago, the impulse response of GDP growth to uncertainty, in our simulated model data, you get an impulse response that is this red line. So they kind of line up this idea that our disaster IV approach can pick up the negative impact of uncertainty in a coherent fashion within some theoretical structure is validated at least within this model. Okay, and so it also turns out to be the case, as you'd be unsurprised to hear, that there was a pretty disastrous event during the last year, this whole COVID-19 thing. If you fit the changes in levels and second moments into the VAR that we saw early in the pandemic, you can get GDP forecasts that are not too far from what we saw in the data. Given the time constraints, I want to go ahead and stop there and say thanks so much for being here.
I think we still have 1 minute for you to show us the slide that went by.
Oh, okay.
About the COVID-19. Yes, I think
so,
you maybe want to spend a minute here. Everybody would be interested.
Wonderful. Okay, perfect. So during the initial onset of the pandemic in March 2020, there were big movements in asset prices, shifts in both levels and volatility or uncertainty. And so what we did using this VAR framework is we took the shifts that we see in the US in early March of 2020 in both first and second moments and plugged those into our VAR framework to get a predicted forecast path for real GDP growth in the US, given only that initial asset price set of shifts on the pandemic's onset. You can look then at the total impact of the first and second moment innovations we saw early in the pandemic, and that's the blue line, the impulse response to both of those. And the red line is just the contribution of volatility increases we saw very early on in the recession itself. So what you're going to see is we're predicting using just that real-time initial data, GDP growth declines of somewhere around 7% in the US in that first quarter, there was subsequently much fiscal stimulus that meant the recovery was a lot better than this would predict. But it's very much the case that the initial magnitudes of GDP declines that simple real-time VAR analysis would predict were kind of spot on to the initial declines in activity we saw in the US. All right.
Thank you, Stephen. If anybody has question, please remember that you can write the question in the on the website platform for the conference. We'll wait for a couple of questions. Maybe some of the panelists have questions. Otherwise, I have a question for Stephen.
Of course.
Okay, I'll go ahead. My question concerns the identification with the disasters. You mentioned that you have a lot of small economies for which a disaster probably wiped out, I don't know, 30% of the economy, or it was really a very serious event. My question is, what happens if I think that countries have different level of assets stashed away to face disasters? Or in a way, if they have insurance, if these countries had full insurance, they wouldn't care about disasters at all, or for sure they wouldn't care about the uncertainty brought about by disasters. And it might be that some countries do not receive any help, or have very difficulty, a lot of difficulty insuring against these events. Other, maybe the US, they are able to guarantee both, reconstruction in the case of a disaster and very long-term, the payoff for the long-term impact, which means reducing the uncertainty. So does this have any bearing on the estimation, the fact that it can be heterogeneity across insurance levels?
So absolutely. So of course, what we're emphasizing, especially with 15 minutes, is kind of like the full sample pooled results here. There's tremendous heterogeneity in our data across countries and time periods. And we have both a range of different development levels, as well as a range of different levels of openness and kind of institutional structure across countries. And so we're very sympathetic to the idea that there might be heterogeneity from some mechanism, including the one you described, in a nation's ability to insure itself against these shocks or respond generally to disaster. So we are able to empirically attack this to some extent, okay, by looking at subsamples within our data. And in particular, although I don't know immediately exactly how I would map some notion of, their ability to kind of have nice storage technology or something like that to our sample. We might look at the financial development or something of that nature. A simple version of what you're asking for is to sort by development levels, and to search by how rich a nation is. And what we see is that for the rich nations, the high GDP per capita nations, it is very much the case that these impacts of higher volatility are lower. They're lower by about half. So a 1 standard deviation increase in volatility predicts a very large decline overall, about 6% in GDP growth in the main sample, and it's only about 3% for high income nations. Very consistent with the idea that there might be some sort of insurance mechanism like you're describing, although with that simple sample cut, we're not putting our finger on the specific one.
Okay, thanks.
Thank you.
We have maybe a minute or two for other questions. I don't see questions from the audience. Don't be shy. Please write your questions. We're all very keen on hearing comments. Maybe somebody from the panelists has a short speech. Okay, we still have a minute. Then let me ask a second question to Stephen, because this is such a rich paper. If when you look at, I guess, natural disasters, I guess from the point of view of the stock market volatility, financial disasters are just as large, might be as or more important than natural disasters. Do you have a way to look at events that you would call do you have a data sets of financial crisis that you can use to build the same kind of exercise?
So I think there's very interesting work actually along the lines of what you're describing. So the work that Sydney Ludvigsen and Serena Ng have done on VAR identification using basically financial event-based methods actually incorporates exactly this flavor and has been a successful research agenda for them over multiple papers. And the idea in that agenda is to look at things like, you know, the late 80s, what was Black Monday or Black Friday, I can never remember, like the big stock market crash and events that are kind of very sudden in the financial system for identification. And you know, what they find is that there are kind of big negative impacts of a particular type of financial uncertainty, but that fundamental uncertainty doesn't appear to move that much. And so there's a lot of richness doing exactly what you're describing. And in principle, one could do similar things in our data. I would be a little worried or I would have to think more about whether we would want financial crises to be thought of as something on the right-hand side that kind of falls out of the sky and can cause shifts in first and second moments, or whether they might be a response to shifts in first and second moments. And so I would want to think carefully about that before exactly porting it to our data. But again, off the top of my head, Sydney and Serena have done already very interesting work along those lines.
Thanks, Stephen. I don't see any question from the audience, so we'll move on to the next presentation. We have Lukas Freund, who's going to present his work on volatile hiring uncertainty in search and matching models. Please go ahead and try to share your slides.
Right, thanks so much for the opportunity to present this paper. Can you see the slides?
Yes,
no, that
perfect. Thank you.
Fantastic. Right, yeah, thanks so much for the opportunity to present this paper. It's joint work with Wouter de Haan and Pontus Rendel. And what we do in the paper is essentially to reappraise how uncertainty shocks transmit to the economy in search and matching models of the labor market. Now, in this particular session, I probably don't need to do too much to motivate in broad terms why we might want to look at that question. But more narrowly, really, we are inspired by and built on the important work by Leduc and Liu's 2016 JME paper. And what that work does is it shows not only that an increase in perceived uncertainty of the sort that Stephen Terry also just talked about causes a rise in unemployment, but also that a really canonical search and matching model of the labor market, you know, Diamond, Mortensen, Pisarides style model can match that conditional moment, and it can do that without having to rely on nominal rigidities. Now, when it comes to the sort of explanation of this finding, Leduc and Liu conjecture that the reason is that these search frictions, which I'll describe more in a second, that they give rise to the same sort of option value of weighting that, again, Stephen Terry just talked right at the end of his presentation about. So the idea there is that an increase in uncertainty can make it more attractive to postpone investment, including in job creation. So against that backdrop, the paper makes 3 contributions, and I'll sort of rush through them now, and then hopefully I'll explain them in a little bit more detail one by one. The first is that we argue that it's very important to differentiate between 2 types of or interpretations of uncertainty shocks. So in particular, we show that search frictions, as in search and matching models, are indeed sufficient for average unemployment to be higher during periods of realized volatility. But the mere anticipation, they don't mean that the mere anticipation or perception of a more volatile future, that causes a rise in unemployment. In particular, number 2, we show that, contrary to that conjecture, option value considerations play no role at all in the standard search and matching model with free entry conditions. It's a bit disappointing. So in the third step of the paper, we propose an alternative search and matching model, which does feature a robust option value of weighting, so that an increase in uncertainty and perceived uncertainty causes a reduction in job creation and ultimately a rise in unemployment in line with the data. Okay, so let me sort of go through a little bit step by step, a little more slowly through these different results, and start by just setting out what actually the theoretical world is that we're talking about. So here, what I've sketched is really a bare bones version of this canonical search and matching model of the labor market. Now, many of you will probably be familiar with that model, but just to bring everyone sort of on the same page, essentially what that model does, it describes the evolution of unemployment or employment over time as the result of the relative number of job losses and formation of new matches between unemployed workers and entrepreneurs. And we look here really at the simplest possible model. So job separations just occur at an exogenous rate delta. So the focus is entirely on these new matches. And specific to the presence of such frictions, these matches aren't formed instantaneously on the spot market, but instead according to a matching function, where the number of new matches is characteristically increasing in a concave manner in the number of vacancies posted by entrepreneurs and the number of unemployed workers searching for a job. As you sort of can see already, we're really focusing on the simplest version. For instance, we assume risk neutrality on part of households, at least for this presentation, as well as flexible prices. And in that case, really the only non-trivial decision problem is that of unmatched entrepreneurs who need to decide how many vacancies to post. Again, this is pretty much a textbook version, and we're short on time, so let me just sketch the equilibrium equations here. The value of an entrepreneur, J here, is simply the amount of that's produced, Z. So Z is aggregate labor productivity minus the wage. And the second component is the discounted continuation value. So that discounting takes into account both the household's effective discount factor and this exogenous separation rate delta. Note that this wage function here is simply, in this case, linear in productivity Z, where omega is the bargaining weight, it's an outside option. So that as a result of this match value is linear. And some of you might find that a little bit unusual. We essentially, one can motivate this linear specification through something like an alternating office game. In the paper, we discuss in a lot of detail what the perhaps somewhat surprising implications are of instead adopting the very popular Nash bargaining assumption, but that for simplicity, we'll really focus on this linear wage specification for today's presentation. Now, that match value, that J, together determines the vacancies, the dynamics of new vacancies posted, and therefore really crucially matches, together with a free entry condition. That's the third line here. So implicitly, we're assuming that there's always sufficiently many potential entrepreneurs so that the benefit of posting a vacancy is equal to the fixed cost of doing so, which is kappa. That benefit is simply the product of the value of a match once formed, J, and the probability that conditional upon having posted a vacancy, that vacancy actually turns into a productive match, which occurs with a probability H. And that probability H is decreasing the more vacancies there are relative to the number of job-seeking workers. Lastly, we have this very simple law of motion for employment, right? So employment and PRT is simply those matches that survived that exogenous job destruction plus any new matches that were formed. And we'll look in that more in a second. Now, given that we're talking about uncertainty, we have exogenous processes not just for the level of aggregate productivity, but also for the standard deviation of shocks to the level. And when we talk about uncertainty, we're thinking here about increase or innovations to the standard deviation of shocks to the level. Okay, so that's the setup. So let's ask then, what are the effects of an increase in uncertainty in this framework? And again, we argue that it's important to differentiate between two types or two interpretations of uncertainty. In that first interpretation, which is also the focus of, for instance, Leduc and Liu, we're really asking what the pure uncertainty effects are, the effects that arise when agents adjust their behavior in the present, in light of the expectation that the future is going to be more volatile. Now, as the solid line shows, we have very little work to do in this particular case because those pure uncertainty effects in this model are just zero. Observe, though, that these pure uncertainty effects are different from the question, what happens on average when the realized volatility in the economy is higher? These, what we label total volatility effects we see, are not uniformly zero. So for instance, we see that even though this match value, the average value of a match when volatility is higher on average, isn't affected, we see, for instance, that unemployment is actually gradually increasing over time. raises the question, how is that possible? And really the reason is that this matching function, the search frictions, are distinctively nonlinear in nature. And in the paper, we go through these sort of different variables of interest, but today let's just think about the employment rate. And from that law of motion, right, we saw here again the unemployment rate increases over time. That law of motion simply says that we can decompose the number of new matches into the product of those job seekers, those workers seeking for job, and the job finding rate. Now, in a boom, the job finding rate is high, but is multiplied by a very low or small stock of unemployed job seekers. In a recession, the job finding rate is low, and the fact that it's low is multiplied by a very large number of job seeking workers. And as a result of this asymmetry in the labor market, on average, when volatility is higher, unemployment is higher as well. Now, that leads us back to this question, why these pure uncertainty effects, these effects due to anticipation effects, why are they zero? And more specifically, perhaps, why are there no option value effects? In a sense, I guess some might be unsurprised by the fact that these pure uncertainty effects are zero, because again, we sort of constructed the model in a way that the match value is zero. Alternatively, you might be surprised because again, it seems to contrast with the conjecture that this model embodies option value of weighting effects. And that conjecture, that option value conjecture, is actually pretty intuitive. After all, typically we associate option value effects with non-convexities. And indeed, as I just described earlier, the session matching model does feature non-refundable vacancy posting costs. So job creation is very much like an irreversible investment. The reason that nevertheless, the standard session matching model cannot feature an option value of weighting is the free entry condition. The free entry condition says that in any state of the world, at any point in time, the expected profits from vacancy posting are zero. Hence, there is simply no point to weighting at all. And in the paper, we sort of associate this, or just provide some intuition, try to provide some additional intuition by saying that irreversibility, hard word, isn't sufficient for an option value to exist. Instead, you also need that these two different investment projects, or in this case, investing now versus waiting and investing later, are mutually exclusive. This mutual exclusivity is not satisfied in this particular session matching model, because even though we could argue that for any individual entrepreneurs, they're mutually exclusive, for the economy as a whole, there's always another entrepreneur who can come in and create that match and thereby fully exhaust profits. So this is a bit dissatisfying, I suppose, and it is unsatisfying for multiple reasons. On the one hand, I think many would say that this option value explanation is a credible candidate to rationalize the empirical finding that higher uncertainty causes higher unemployment. In addition, it's not at all clear that this free entry assumption, which drives the no option value result, is a good one, neither a priori nor empirically, as far as I know. What it does do, of course, is it provides a lot of tractability. So in that very last part of the paper, what we do is we propose a modified session matching model, which contains the attractive properties, but which gets rid of the free entry assumption, which does feature a robust option value of weighting, and which remains tractable. So let me just spend the last couple of minutes by sketching the key ideas of this modified model. There are two modifications, as you can see here. The first modification is that we suppose that the number of available entrepreneurs is finite. And second, that there's heterogeneity in productivity among the idle or unmatched entrepreneurs. And specifically, what we say or assume is that in every period, each unmatched entrepreneur receives an IID productivity draw from a mean zero distribution. Now, if an entrepreneur actually creates a firm, so posts a vacancy, hires someone, then that draw is realized. It lasts permanently up to the point of exogenous separation. And during that time, she cannot be involved in a different match in the meantime, mutual exclusivity. If on the other hand, the entrepreneur doesn't create a new firm by choice or by chance, she receives a new draw in the subsequent period. I know that this first assumption of there being a finite mass of entrepreneurs is actually sufficient for an option value to be restored. And the key to that is that in this world, this entry margin is no longer perfectly elastic. So movements in labor market tightness of the hiring rate no longer necessarily are expected to exhaust all profits from vacancy posting. But the problem is that this model has a sort of without the second assumption, has a bunch of really unattractive properties. So for instance, you have to postulate that for an option value to exist, there exists states of the world where there are simply no entrepreneurs left whatsoever to create new vacancies, irrespective of how great the profits associated with that might be. That's also computationally quite intractable. With firm heterogeneity instead, as I just sort of sketched it, we have a very simple solution where there's an endogenous cutoff level for that idiosyncratic productivity, so that those unmatched entrepreneurs that have a draw above that cutoff, they expect strictly positive profits, very different from the baseline model from entering, and therefore enter by posting vacancies, while others find it more beneficial to instead wait for the opportunity to receive a better draw in the future. So, in that sense, the value of an unmatched entrepreneur is no longer zero by construction, which is what we forced it to be earlier. Instead, it's given by this expression here, where essentially we show, and this is here is at the time prior to the revelation, that the value of an unmatched entrepreneur can be given by integrating over all possible productivity draws, and the integrand is simply the maximum of the payoffs from either waiting or entering. Well, if I wait, I simply remain unmatched next period and have the opportunity of getting another productivity draw. If I post a vacancy instead, I pay kappa. With probability H, I hire a worker, form a productive match, and with that productivity draw A being the determinant of the value of that match. And else, if I don't manage to find a worker, then I remain unmatched again. So you can sort of already see, I suppose, where the value of waiting comes in here, given that we have this max operator. It's really the idea that, higher dispersion, let's say for now, idiosyncratic productivity draws, they provide the entrepreneur with upward potential, but they're shielded from downwards risk because, they can always choose just not to enter at all. What this very finest load shows you is that in addition, and in a similar way, but with a subtle difference, an increase in aggregate uncertainty likewise pushes up the value of waiting. And the intuitive logic here is that, the intuitive logic is that in a time of high aggregate productivity, the expected value of production, conditional upon entering is high, right? Aggregate productivity is high. But the level of idiosyncratic productivity needed to cover these vacancy posting costs kappa is low. So the probability of having such a draw is really quite high. In low aggregate productivity states, the expected profits are lower, but the deep extent to which these profits are lower is muted. Why? Well, precisely because those entrepreneurs with lower draws, they can avoid entering in the first place, instead make zero profits. So what the solid line shows here is that in this modified model, when perceived uncertainty increases, right, we're looking at pure uncertainty effects here, the value of waiting, the value of unmatched entrepreneur goes up, and fewer firms enter, fewer entrepreneurs enter. As a result of that, there's fewer vacancies, it becomes harder to find a job, and ultimately unemployment goes up. In the paper, we have a bunch of other things as well, quantitative comparisons, the recalibration scheme, we're looking at these Nash bargaining assumptions, but for today, I'll just leave it at that, leave you with these 3 takeaways, and yeah, if there's any questions, I'd be very happy to answer them.
Thank you, Lucas. We'll give a minute to the audience to react if there are some questions. Anybody from the panelists in the meantime has a question for Lucas?
I had a question. So I wanted to say, first off, thanks so much for the talk. Very interesting and great presentation. So I like the kind of identification of the free entry condition as the culprit here. And I think your kind of resolution of that theoretical puzzle is quite attractive. In the back of my mind, should I be thinking of these entrepreneurs, the story you're telling in the model, as something that could match into a firm, the firm that is existing and is a going concern, and that is simply considering whether to not post that vacancy for that position they want to fill today versus tomorrow? Like, can I think of this story as basically integrating naturally into a heterogeneous firm structure? And if so, what differences might show up between an entrepreneur interpretation or a firm interpretation? I guess the firm interpretation, there's correlation of productivity across vacancies maybe that might show up. So how should I think about that?
Yeah, super interesting question. Thanks so much.
Lucas, before you reply, I have a question from the audience I'd like to add, so you can answer both questions at the same time. We're asked whether you can explain a bit more the role of the wage bargaining assumption for the results that you have, especially in relationship to the Leduc and Liu paper. Thanks. So please go ahead. You've got a few minutes to answer both questions.
Yeah, thanks also for that additional question. Let me just take them in turn. So to the first question, I think you're right. There's sort of two different interpretations. And the one that's easiest, no doubt, is really to think about it as these, entrepreneurs who can match with one other worker. And I guess one way of thinking about these idiosyncratic productivity draws there, at least in my mind, is a little bit in the background, there's an occupational choice problem almost, like in a Lucas style way, where I can choose as in given my idiosyncratic productivity level, whether I want to become a worker or an entrepreneur, and only if I have a sufficiently high draw, then I'm willing to post a vacancy. That's certainly the easier way. The alternative way, here, think about it as a firm, as long as we have the constant returns to scale assumption, as is the case here, there's isomorphic interpretations of thinking about this as individual entrepreneurs who post vacancies or there being a large competitive firm. I think what you're getting at is that as soon as I have decreasing returns to scale in production, then indeed there are these interdependencies between the marginal productivity of these different workers. So this is an approach we very deliberately don't take in trying to be very consistent with the search and matching world. But I guess Edouard Charles' 2017 Econometrica paper shows that that is indeed an alternative way of obtaining option value of weighting effects while still retaining a free entry condition, in his case, at the level of vacancies. So that's exactly right. Like it's much more natural to think about it in the first way. In terms of the Nash bargaining assumption, yeah, so I'll try to cover this very briefly here. In the paper, we have, I think, 4 or 5 pages on this, and spent a lot of time puzzling what's going on. So in the first instance, here I adopted this linear wage specification to be able to focus on the option value interpretation. Because then it's very clear that in the case of an uncertainty shock with linear wages, these pure uncertainty effects are 0. Now, what we assume about wages clearly doesn't affect whether or not there's an option value of waging. But what we show in the paper is that the assumption of Nash bargaining introduces a very distinct dynamic. In particular, this is what you see at the bottom, that an increase, even in perceived uncertainty, under the assumption of Nash bargaining, does cause a fall in the match value. It also causes an initial drop in the wage, but then an overshooting of the wage, and a rise in the unemployment rate. Now, there's a little bit of an intricate pattern of paths, I suppose. Essentially, what's happening is that this labor market tightness theta is a convex object. So when uncertainty increases or volatility is expected to increase in the future, the expected value of labor market tightness in the end, in the long run, let's say, is higher. With Nash bargaining, the worker benefits from higher expected labor market tightness in the future. So when uncertainty goes up, I expect that labor market tightness is going to be higher. Therefore, also expect that my Nash bargain wage is going to be higher. Therefore, expect that productivity is going to be lower. That pushes down the expected value of the match value. Therefore, that reduces the expected value of vacancies posted in the future. And that's how we get this effect. There's an additional twist, because given that vacancies then actually fall due to the fall in the match value, this of course lowers the expected value of labor market tightness in the short run, which is why initially in the first couple of periods, the wage actually declines. So that's quite a little bit of an intricate loop. The short story is that Nash bargaining introduces non-trivial additional implications for the transmission of uncertainty shocks. but it doesn't affect in any way whatsoever whether or not there's an option value in the model. I hope that answers the question.
Thanks, Lucas. It answered it. For me, it answered it. We'll see if we get some feedback. So thanks very much. We'll move on to the last paper of the session, and Stephen Terry is kindly accepted to act as chairman while I'll present. There's also my co-authors present, so let me try to share my slides. And give me a nod if you see the slides.
We can see them.
Okay. Okay. Very well. So this is joint work with Giovanni Pellegrini at Aarhus University and Gabriel Zulig at Denmark's National Bank and the University of Copenhagen. And it belongs to a large number of works that was born during the first 20 days of the first wave of COVID, when we were trying to figure out whether we were facing apocalypse or not, and what would happen. And we focused on the impact of uncertainty shocks. And we are going to have some results coming from a statistical model, and these results are sandwiched between two messages we'd like to deliver. One is how much uncertainty affects spending behavior, and the other one is why policymakers need to have clear policy plans and why it pays off. And everybody who thinks that uncertainty shocks matter will agree with the conclusion. So let's look first a couple of data for the US. From March to April 2020, there was actually an increase in personal income in the US, as there was a lot of fiscal support being channeled to US household, but consumer spending was falling from March to April at the rate of about $2 trillion. So we saw large increases in the personal saving rate in the US. One could say, well, that you simply couldn't spend money because you couldn't travel on a cruise, and that's certainly true. However, even if you go further in the pandemics, at the end of the summer, when in a survey by the New York Fed, US households were being asked, well, what will you do if there is another fiscal stimulus? The response was that they would save 50% of it or more than they actually had saved the first fiscal stimulus. So it seems that not only the bleak outlook about the future, but the possibility of very bad outcomes in the future, which is what we call uncertainty, was affecting the optimal behavior of US households. So that's what we're going to focus on. Item number 3. Yes, lockdowns implied that spending fell, and yes, if there is an expected increase in the chance that you will get unemployed, you will start saving. But there was also a lot of uncertainty as measured by a ton of indicators, which meant that there was dispersion across the possible scenarios for the economic outlook, conditional on having the same average economic outlook, which was bleak at the time. So we are going to use an integrated VR, which is a kind of nonlinear model to figure out what happens when there is an increase in a particular shock, conditional on some variables. For us, these variables are the average outlook of the economy. So we would like to know, well, do the changes in uncertainty affect differently the economy, depending on whether you have essentially pessimistic or optimistic expectations about the future. And the answer is that you need bleak and pessimistic expectations about the average outlook make the impact of uncertainty shocks much larger. So we We're going to use Euro area data, which means that we're going to go back only to the late 1990s, so that we have a number of countries which share the same currency, the euro, and with data available. Here you see two plots, one for consumer confidence that of course plummeted in 2020, but as you will see, during the financial crisis and then also during the sovereign debt crisis in the euro area, consumer confidence was reaching similar levels. So the COVID pandemic is not the only event historically that brought consumer confidence this down. And you see the equivalent of the VIX for the euro area stock market. It's called the VSTOXX. It's an option implied index. And you see the huge increase in uncertainty in 2020, which mirrored the size of the increase in uncertainty after the financial crisis. And while uncertainty has decreased lately, in February, the VIX level was still 80% higher than its average in 2019, so in the pre-pandemic time. The point of everybody working on uncertainty, both modeling and empirically, is that there is a hypothesis that uncertainty is going to impact optimal choices independently of the average outlook of the economy. And one easy example to think of this is suppose that you are a firm or you are an entrepreneur, and you're always worried about bankruptcy. Well, if you are during a downturn of the business cycle, the probability that the same size shock, same size first moment shock will drive you to bankruptcy might be 40%. If you are in an expansion, it's much smaller. Therefore, an increase in uncertainty that makes possible negative outcomes more likely is going to affect a lot your optimal behavior, because now suddenly you have a high chance of these very dark scenarios of going bankrupt. So that's how we think of uncertainty affecting the optimal behavior. Now we would like to measure this impact. So we'll use a IVAR model, which is, let me go to the equation, which is a nonlinear VAR specification. We use monthly data. In an integrated VAR, you will have a term which it's a multiplicative terms combining the level of the shock, the uncertainty, which of course being a VR, it's also one of the observable variables, with the conditioning variables. In our case, it's a measure of confidence, is what is called conf T minus J. So that's the interaction term. And this, remember that this means that the model will be nonlinear in the initial state where you decide to start a simulation or to have an uncertainty shock hitting. And that's the nonlinearity that we are going to exploit. That means that we can estimate the model over the whole sample of data, as opposed to other nonlinear models where you need to choose ex ante over which sets of data are the kind of the bad state and the good state. Here we use one estimation, but then when we compute the impulse response function, we condition on a particular set of initial states, and we need to define these initial states. I'll show you a plot in a second. But essentially, we need to decide, okay, in the sample, what do we define as pessimistic times? Let's look at the vector of variables during what we define as pessimistic times, and let's look at what an impulse response function would look conditional on this pessimistic initial conditions, which means that you can change your definition of what is a pessimistic state. I call it pessimistic because for us it's a confidence in the future outlook. We have maybe 15, 20, several different specifications, but the basic one includes an uncertainty index, industrial production, because that's something that we can measure at the monthly frequency, year-over-year inflation, a measure of confidence. So we'll also use business confidence, not only consumer confidence, and a measure of monetary policy for us in Europe is the overnight interest rate. We also use different measures. This is the plot that I promised. We take as a benchmark and the pessimistic times the bottom 20% of the distribution of consumer confidence, which corresponds to the gray shaded area. If we could have chosen the bottom 10% or the bottom 30%, and we do these experiments in the paper, and the results are very robust. So this is the results looking backward on what happened using data up to the month before the COVID pandemic. The solid black line is the impulse response function of industrial production, inflation, and uncertainty during pessimistic times, and the dashed line is what happens when you condition on the top 80% of consumer confidence outcomes. The key result is that industrial production falls by about 3 times as much and in a significant way statistically compared to your estimate during normal times. And similar result you get for inflation. Notice that this uncertainty shock is very mildly deflationary, but it has a substantial impact on industrial production. The second result is that when we look at consumer confidence, which is also one of the variables, it's not only conditioning variables, but it's including the VAR, the response of consumer confidence is only marginally statistically significant. That gives us some hope that
5-minute warning.
Yes, that gives us some hope that we're not running in the problem of consumer confidence and uncertainty being moved exclusively by a common factor, and so mixing up inference of changes in uncertainty with inference of changes in consumer confidence. Let me move on then. A lot of the reaction of a lot of people was, is this really true? You should try this and that, and they're right. So we tried this and that. On the first, on the top row, you see what would happen if we used in our estimation during normal times or during pessimistic times, other measures of uncertainty, and the results are very robust. We also looked at different measures of confidence, so which means we included different confidence measure in the IVAR, and we also will condition on a different set of initial states for pessimistic times, which always correspond to the bottom 20% in this example. And so we look at disagreement, measures of disagreement in consumer outlook, or measures of disagreements coming from the business sector. And the results are fairly similar, so we feel comfortable with the robustness. We have, I don't think we want to comment every other single outcome, but let me say that again, trying to address the issue of are we measuring uncertainty or confidence, we also tried with having confidence orthogonalized, so projecting confidence on uncertainty so that we would net out the impact of uncertainty shocks on confidence itself, and the results are very robust. Now, I want to mention one interesting hypothesis, which is, well, maybe it's not the level of confidence, but it's the change in confidence. So maybe it's what we call the mood swing hypothesis. Maybe what matters essentially is the growth rate in confidence, because our pessimistic times also include times when confidence is recovering. And it turns out that this is the green line. We still get the result, not as strong. It falls by about 40% the size. But also, if we interpret, well, pessimistic times are times when confidence is falling. So we exclude the recovering confidence. So the level might be low, but it's recovering. We still get the same result that, well, this will matter only in pessimistic, uncertain shocks will be important only in pessimistic times and not in normal times. I want to use the last minute to think about, well, what about COVID recessions? it's always difficult to use models to assess what is the impact of a 10 standard deviation shocks. So that's what we did at the time of when we wanted to assess the impact of COVID about a year ago. But we can do something, which is we can go back and build the following experiment. Well, we know what happened to uncertainty, and you see the 10 standard deviation shock on the first panel, on the first row. So uncertainty increased, and then we know the outcomes. So we can ask what would happen if we had a series of shocks that would match, that would be such that the uncertainty variable matches what we actually saw in the data. And what happens is in the second panel to industrial production. So the green stars, this is what actually happened to industrial production, and the red line is the impact of uncertainty as the model assesses it. So uncertainty implies a fall in industrial production by about 12% at peak against the total a peak fall of 40%. Of course, that's the first moment shock impact. This in terms of GDP translates in about 3.3% of euro area GDP. So about a third of the shock is attributed to the impact. A third of the fall in industrial production is attributed to the impact of uncertainty alone, conditional on the confidence level that we were observing. Then, of course, industrial production recovers much faster because there's been a lot of policy that is not included in the VAR. So that's the reading of the model for what happened after the first wave. We also have a simulation of what would happen, what would be the role of uncertainty in the third wave if we assume that this had about half the size, the uncertainty shock, as the first and second wave. And you see that what's key is that during pessimistic times, the impact of an uncertainty shock, it's more than 4 times as high as if you were at the times of average confidence. So the message is what really matters for uncertainty shocks is what is the average outlook, because uncertainty shocks will have a large impact at times of pessimistic expectations. So I'll conclude here to leave space to some questions. What we see is that using euro area data, pessimistic expectations over the average outlook, they imply a very large impact of uncertainty shocks on the economy. The impact in normal times would be for most specifications statistically not significant. And for COVID-19, well, this was a double whammer for the economy, because you get a very pessimistic outlook at the same time as you get a very large uncertainty increase. I'll stop here and be happy to answer your questions.
Thanks so much, Federico. So at the moment, we do not have audience questions, but given the lag with the live stream, that might be normal. If the panelists have any questions in the meantime, now would be a great time.
Maybe one question, just picking up on the very last point that you sort of have on the slide here as well, where you described that the COVID disaster shock is in some sense a very perverse combination. I mean, including the papers of really uncertain business cycles, I think at least my reading was that it suggested oftentimes you have a combination of first moment and second moment shocks. So in what sense do you think this additional amplification channel generalizes more broadly, or do you think that COVID is particular to the lens of your analysis?
Thank you so much, Lucas. Federico, just a moment. There's another question as well, so we're going to accumulate. So Alessio Volpicella wants to know if you've tried identification schemes other than a contemporaneous exogeneity assumption for uncertainty.
Yes. Okay. So, the model is estimated over pre-COVID shocks. So, anything that would, what the model is saying is conditioning on pessimistic outlooks mean that you will get a large impact of uncertainty. We get a very large impact with COVID simply because uncertainty increased by an historically an enormous amount, although not an unseen amount. I think the impact that we get for uncertainty shocks is in line with also linear estimates, except that the message that we get from the estimation is, well, it could very well be the case that in estimates which are not state dependent, all of the impact that you get from uncertainty shock is coming from these episodes where you have pessimistic expectations. I don't know if that was the question that you had in mind, Lucas.
Yeah, that's fine. Thank you. Thanks so much.
Okay. And as for either identification, yes, we tried. I think a lot of our concern was about having the right variables. So if you look at the paper that we have, we tried quite a bit of different alternative variables, both uncertainty, confidence, but also adding financial variables that could play an important role. We used a Cholesky identification where uncertainty is ordered first. We tried alternative orders. We also tried with a proxy VAR, sort of instrumenting using volatility in the price of gold. I don't remember if we tried something else. Maybe if Giovanni Pellegrino is on the online, he can also add. Giovanni is a co-author on this paper together with Gabriel Zulig. Giovanni, are you on Zoom?
Yes, can you hear me?
Yes.
Yes. Oh, Federico, thanks. Well, you were right. We did all these checks, and so we basically used the price of gold as instrument following the paper by Piffer on EJ, and basically we use the percentage change in the price of gold, which of course is a safe asset. So you can think that when uncertainty is high, there is a fly over this asset, and then these changes will reflect sudden or exogenous increase in uncertainty. On top of this, we also use another check with the instrumental variable VAR, where we use basically the Bloom dummy coming from econometrics as external instrument, and again results were very robust with all these checks. Thanks for the question.
Stephen, go ahead.
Perfect. Well, Federico, I mean, you are the chair. I defer to you now. You can take back over.
Okay, well, I think our time has run out. I would like to thank deeply all the panelists and also all the participants. I think we managed to add some value on the debate on risk and uncertainty in macroeconomics, both from the empirical and theoretical point of view. So for me, it was really great to share this session. Thanks to all the participants.